Disney shares tumbling almost 8% today. Its worst day since April. The media giant reporting better than expected earnings before the bell, but missing on revenue. Disney's TV networks and movie business weighing on results. The company is also in a carriage dispute with YouTube TV. CNBC founder and current contributor Tom Rogers joins us now with his reaction. Tom was the first president of NBC Cable and is now senior advisor to Versant Media, which will soon become CNBC's parent company. Tom, it's always great to see you.
Great to be here.
So what's your take on Disney's earnings in the context of the media landscape changing so quickly around it?
Well, I think there was probably greater expectation that there was going to be some acceleration on the streaming front, which, of course, is the future of the company. They certainly have stability in the parks area, but the exciting part that people really want to see growing is the streaming. And there really wasn't any clear indication of a catalyst there. So I think that was the major disappointment. Certainly when it came to linear, everybody expected the traditional side of the TV business to be weak. It was, but relative to many of its peers, it did better. So I can't really point to that as being a basis for this kind of market reaction.
What I thought was really interesting was when CEO Bob Iger on the conference call was talking about Disney Plus as a platform, which is going to be much more than just a content platform, almost like a super app where AI will help connect Disney fans to other parts of the Disney business, like the theme parks, as well as movies, et cetera. I guess the street wasn't moved by that, but I'm just curious, Tom, to see what your reaction is to that sort of grand plan, because in the longer term, that seems like an interesting idea.
Well, I think it is an interesting idea, and there are clearly things they could do to bring in a greater notion of membership by their consumers into Disney through the Disney Plus. I think they first got to show that they can integrate Hulu well, bundle ESPN in its streaming form well. I think they pointed to the fact that 80% of ESPN subs were part of a Disney Hulu bundle, which is promising because that really is going to be the strength for them to build on AI and new elements of what that can be. Being the only player in the streaming marketplace that really has strength in children and family, strength in adults, strength in sports, all in one place at the magnitude and depth they do. And they really got to show that that's going to be a catalyst. I think there were so few new Disney Plus subs for the ESPN streaming service to attach to that it hasn't proven to be a catalyst yet. If they can prove that that's really going to reaccelerate their growth in the streaming area, I think that's something that people might get excited about.
Godfather, I know we're the fast money traders, but I feel like the stock overreacted today. I know these numbers weren't, they didn't provide that preview into a catalyst, but at a time when the ESPN streaming clearly, I think, is given more intrinsic value. I mean, the question is, are they going to have to spend too much on sports rights? But this is a company that also, they're finally, they're buying back $7 billion of shares. This is a company that actually the balance sheet looks like it's really overcome what was a very difficult time during COVID. So play investor trader here with us. You are the guy that sees the industry from the top down and always have. But Disney has done nothing for a long time. Haven't we priced in this lethargy? And the DTC business is largely pretty solid.
Well, you're right. They're not getting progress for a lot of things here that they deserve credit for. The fact of the matter is that I came on this show for the last 5 years saying, hey, what all these traditional media companies have to prove is that the improvement in streaming is going to outweigh the decline in traditional media. And they've proved that. They are actually growing faster in streaming than the decline in linear now. They've also proved that when it comes to the percentage of their engagement that is coming from streaming, it's about the majority of their engagement now comes from there. And the majority of their revenue is coming from the streaming side. So they've got a lot of transformation that they should take credit for. On the other hand, this was their last quarter of announcing numbers. Now, Netflix did the same thing, but Netflix, when it stopped, was growing 40 million subs a year with 30% margins. And Disney's growing 11 million subs a year, a lot of which are wholesale subs under a charter deal, so very different than the kind of Netflix subs that were coming on board. And when Netflix said no more sub numbers, they pointed everybody to engagement, that's going to be what we really want you to focus on, how well we bring people into the viewership. But Disney didn't even mention engagement on the call. And I found it very strange that they kind of left people a bit adrift of, now, what are the metrics to measure us? Now, certainly revenue growth is one, but they're growing at about half the rate of streaming revenue growth of Netflix. So there wasn't anything there to get people excited about.